Namaskar. We'll be discussing today on the topic called classification of investors. Now, who's an investor? That's $1 million question, right? It's very easily being said that I'm an investor. Everybody says I'm an investor. But investor hota kya hai? Who's an investor? That's what we are. And what are the different types of investors? That is what we will be uh, doing it in today's lecture. So an investor is basically an individual that puts money into an entity such as a business or for a financial return or something, right? The main goal or the objective of any investor is basically to minimize risk and maximize the return. That is what for anybody invest in any business or any entity or any venture, right? And it's the ultimate aim is to maximize benefits or profits and with a minimum of risk. It is in contrast with the speculator who's willing to invest in a risky asset with the hopes of getting a higher profit. Normally, a speculator is also a form of an investor, but since he does it for the quicker return or riskier return and does not hold on to investment for a long period, that is why he is called a speculator who wants a windfall profit as against the normal profit for an investment or let the investment grow into a profitable venture. There are another words for the term called investor. Some synonyms for investors are banker. A banker is also an investor because it lends money to the corporates or the individuals or business houses and all for the return in the form of interest rates and all. And then lenders, other than bankers, financial institutions or money lenders or private institutions or your friends, relatives, etc., they also lend you money at times. So they are also in the form of an investor to that extent. Then the major ones are known as shareholders or stockholders. Shareholder is a person who shares in the equity shareholding or in the equity base of a company, and the stockholder is basically, a percentage of stock he is holding in the company's shares. And this is, they are to that extent, to the extent they're holding these investments, they are known as part owners of the company. Then there is venture capitalist. Venture capitalist is we'll be doing it later, but right now I'll just touch it up here to the extent that venture capitalist is a sort of an investor who collects money from others and on their behalf invests in the securities market or other ventures for earning a higher rate of return as compared to other businesses and all that. They look for a high return ventures. And then there's a term called backer. Backer is a typical type or group of persons or corporations and all that, or a typical group who keeps on looking for opportunities for investments. They have money, but say sometimes they get together and they bid for big projects and all that. So they are called backer. There could be institutional, there could be corporate backer, there could be individual backers as well. And then there's another term called capitalist. Capitalist is a person who believes in the capitalism theory of economics. Capitalism, as all of you know, is basically where the economy runs through the capital market or privately. That means the properties, the income, the businesses, etc., everything is being owned and controlled by individuals or the corporates and all. And it is the owners, they want the maximum business, maximum return out of that. Whatever they do, wherever they deploy their resources, they do it for the purpose of personal gain or profit. That's the basic concept of capitalism. And the person who believes in this capitalism theory, they are the persons who invest in certain ventures or businesses and all that, keeping in mind the profit as a motive, and that is why they are called capitalists. They are also a type of investors. Now, what are investors called basically? A distinction can also be made between the term investor and trader, in that investors typically hold position for years to decades, also called position trader or buy and hold investors, while traders generally hold position for a very shorter periods. You see, those investors who hold for, or known as position traders, who hold or buy or hold investment for long, they do it to let the value increase, to enhance the value of the investments before they wind it up for the liquidity. Whereas a speculator, he looks for a short-term gain and looks for a very short duration during which he can earn, and by rotating his investment in the short term, he tries to maximize his return from the investments. Types of investments. There are three main types of investments basically. We can either invest in stocks, or one can invest in bonds, or one can invest in cash equivalents. You all understand what is all this: stocks, bonds, or cash equivalents. Stocks is basically stocks of the company or shareholding of the company and all that, and bonds are the money, that is the debentures or lent out money to the company in the form of bonds, etc., which earns a typical rate of interest over quarterly, half yearly, or yearly, and are matured. On the maturity, they get the complete amount of investment plus whatever interest they have earned, that is their earning on that. Then the cash equivalents such as gems and jewelry, etc., or property and all, that's the third type of investments. On the basis of these types of investments, we can classify the investors into a simple way of classifying investment is to divide these three categories into the investment methods, which could be: one is debt investment, that is you lend somebody the money, and which is called loans and all that in the general parlance. You earn interest on periodical basis. It could be monthly, quarterly, half yearly, yearly, simple or compound, as the terms you agree with. Or the next type of investors on the basis of these categories can be equity investments, whereas it is called company ownership, right? Where you invest in the company ownership, although on minuscule basis or the major basis, depending upon your amount of investment or your type of investments and all that. There could be a third type, which is a hybrid investment, which is nothing but a concoction of the above two, that is debt instrument as well as equity investments. It is in the form of a convertible debentures, convertible securities such as convertible debentures or preference shares, convertible preference shares, etc. Or you can name it anything, the security could be named, but the basic form is partly or fully convertible. It is also known as mezzanine investment or private investment, capital preferred shares. Then before they are categorized into their different subtypes, an investor is first categorized based on two main categories: active investor and passive investor. Now, who's an active investor? Active investing is highly involved. That means, as the word goes, active investor. The active investor would be very highly involved in the investments he does. Unlike passive investors who invest in a stock when they believe in its potential for long-term appreciation, active investors typically look at the price movements of their stocks many times a day. Usually, active investors are seeking short-term profits. What they do, because as you're all aware, in the stock market, the price movement in any stock is fluctuating from morning till the afternoon till the market closes down. So during the day, whenever the stock is fluctuating, an active investment is definitely keeping a watch not only on the stock but on the other economic activities as well as the political movements also, so that he knows what is going to be the outcome by the evening before the market closes, and he is very actively involved in all these things. Plus he also looks at the other investments such as the price of gold, property and all that, as to how it is going to affect his investments. That is called an active investor, and he is very much involved in his investments from morning till the evening. Then, as against the active investor, who are the passive investors? They are also known as buy and hold strategy investors. Passive investing means buying a security to own it for the long term. Unlike active traders, passive investors do not seek to profit from short-term price fluctuations or market timings. They look at the potential of the stock. They look at the potential of the company in whose stock they have invested and its growth over a long period of time. When they are comfortable and they are firm enough, they believe that it is going to get them good return in future, they just invest and sleep over it, sort of, and that is why they are also known as lazy investors. As we all know, lazy investors means those let it go. We will, not pay much attention to it, not be much involved in day-to-day affairs and all that, and let it grow. And once it grows to my expectation, I will liquidate it and earn my revenue or earn my return on the same. Broad categories of investments are two types. You see, normally whenever we invest, there are two types of broad investments. One is equity, the other is debt. That's the broad investment. Investor may either invest in the equity or in debt or a combination of the both. Now, classification based on the size. There are two types of investors as on the basis of the size. One is the retail investors and the other is institutional investors. Retail investors, as you all know, is as the term goes, a retail investor is someone who buys and sells equity shares, commodities, contracts, mutual funds or exchange traded funds through traditional or online brokerage firms or other types of investment accounts. They are the ones who limit their investments to a smaller sums and all that, and they spread their investments in the sense that they don't keep all the eggs in the same basket, and they keep it in different baskets so that their principal is safe, and they, even if they do lose on one count, they at least are able to save it on the other basket. Now, SEBI law defines retail individual investors as an investor who applies or bids for securities or for a value of not more than 2 lakh rupees in any IPO or FPO, that is initial public offer or further public offer by any issuer of the securities and buys or holds shares worth less than 2 lakh rupees in a stock. There is no such limit in commodities to define a retail investor. And you see, with the help of this limits, the number of investors in the country has increased tremendously, because with every small investor, they are also known as small investor or small investor, it is going to, the number of investors is going to increase, which will ultimately help in generating more and more capital for the economy. And this capital, once rooted in the economy in the productive manner, would generate more and more revenue or growth of the economy, and hence will enhance the GDP of the economy. This is how the investors, these retail investors, also help in building up the economy of the country. Retail investors purchase securities for their personal accounts and often trade in much lower amounts compared with institutional investors. That is why they are also known as small investors. Institutional investors, an organization or company that pools funds from various sources such as individuals or entities and invests them in different market securities such as stocks, bonds, forex, that is foreign exchange, foreign contracts, etc. on their behalf. They are known as institutional investors. The peculiarity about institutional investors are that they do not invest their own money into the market, into these securities. What they do is they collect money and they collect a pool of money from various sources such as individuals, such as entities, companies and all that, or some funds, etc., and then put them in various securities to minimize the risk and maximize the return. That is any investor's objective ultimately. They include such institutional investors. The best examples are hedge funds, mutual funds, endowment, pension funds, and examples of institutional investors. Institutional investors are considered savior than the average investor and are often subject to less regulatory oversight. Now, why they are considered savior? Because they are considered, they are very shrewd, and they're having, they're having the expert knowledge, technical knowledge, and very shrewd ability to make good judgments on the investments they make. That is why they are known as savior rather than an average investor. They are savvy investors. There are broadly 6 types of institutional investors. We will be doing it one by one. A mutual fund. The first example of institutional investor is a mutual fund. Mutual funds are vehicles facilitating investments in variety of securities with capital commitment from several investors. It could be both individuals or otherwise. Now, every day in the newspaper you see one or the other scheme of the mutual fund. There are n number of mutual funds registered with SEBI, and the various schemes of these mutual funds are registered with SEBI. So then investor has, depending upon his objective, depending upon his goal, has an option to invest in either of these schemes and can avoid the risking of his capital for want of the technical and expert knowledge of the stock market. So that is where the mutual funds come very handy, and they invest in a big way. That is why they fall in the category of institutional investors. And each mutual fund, normally for each of these schemes, has a qualified fund manager who handles each mutual fund and the scheme thereof. Nearly every mutual fund includes an array of liquid securities. That means each mutual fund has a variety of liquid securities which gives a comfort enough to the members may retract their investments at any time. In case you need to liquidate your investment in a mutual fund, since they have a whole range of liquid securities, so you can anytime liquidate your investments and can get back your investment and the return thereon. So securities invested via mutual fund usually span across several industries or types. It is designed to minimize the risk of capital loss, wherein the gains from one dilute loss in another security kind. Normally what mutual fund does is mutual fund allocates its investments in such a fashion, such a manner that it doesn't keep all eggs in one basket. Say there could be equity based mutual fund who will be investing say 80% of the investments into equities and 20% in either government bonds or the other debt instruments and all that, to ensure that in case there's a loss in the equity market heavily, then they can at least mitigate it through the debt instrument invested in the debt instrument or the government securities. That is how they balance the fund, balance the investment for the benefit of the investor. And that is what the mutual fund is known as, a balanced investor in the market, and it helps in basically the economy to get huge capital inflow for the corporates and the economy. The gap, the burden on the banks is being reduced by their investments. Next type of investor is the hedge fund. Hedge fund can be best described as an investment partnership where the money collected from members is pooled to invest in the securities. Here there is a fund manager who is called the general partner and a bevy of investors called limited partners. A bevy of investors means a particular or typical type of investors who are interested in some specific or particular type of investments or particular industry where to be invested in. And these funds, they collect money for and on behalf of the limited partners. Those limited partners, they commit their amount of investments to the fund, to the hedge fund, who in turn invest for and on behalf of those limited investors whenever there's a good opportunity of making a much better and huge investments, or the investments which can earn big gains on their investments. Their characteristics are somewhat consistent with mutual funds to reduce risk and enhance returns via diverse portfolio. Hedge funds distinguish themselves with more aggressive investment policies and are more exclusive compared to mutual funds. Normally, hedge funds, they invest very aggressively. They invest in riskier projects where they expect that the returns are going to be big ones. So that is why they are also perceived as riskier investors. And naturally, when you take a risk, the returns are even more substantive there. The next type of institutional investor is the insurance companies. Insurance companies are heavyweight institutional investors. Normally, these institutions employ the premium they receive from policyholders into the securities. Since aggregate of premium is considered, their investments are also sizable in nature. The returns insurance companies receive from trading are deployed to pay for claims. And you see, especially in insurance companies, normally you would appreciate that since they are so huge investments which they have made in the market, and virtually everybody takes life insurance, and life insurance, the major part, that's the term insurance. God forbid, God willing, nothing happens wrong with you, but in case you live your life beyond the policy period, your premium which you had been paying for term life, that is being forfeited by the insurance company. You don't get any return on that. It is only within the insured period that in case any mishap happens, in case any mishappening happens to you, then your dependents and all that, your heirs, they get the claim. They can claim the insurance amount, and that is what the insurance companies give. So most of these insurance claims, which is insurance premium which is unclaimed, that is the profit of the insurance company, and that's how they run it. Next is endowment funds. This is something very interesting, very good type of investors. You see, normally all these educational institutions, these are being set up by the foundations where the administrative or the executive entity utilizes the funds for its cause. Typically schools, universities, hospitals, charitable organizations, etc., they establish these funds for specific purposes to achieve a specific objective or purpose, and whenever they do it, what they do, the endowments, the what you call the gifts, etc., and all that, what they get from their ex-students or some other agencies and all that, they keep them intact as the principal amount, and that principal amount is being invested in various securities, etc., generally being invested in the government securities or the debt instruments, so that the principal and the investment is safe. And whatever earnings they get out of that earning, they don't touch the principal. The earning, what they get, they invest that earning for the cause of the endowment fund for which it had been established. Here the investments usually act as a deductible for the investor. These funds are so designed that the principal remains intact, and the controlling organizations uses the investments income to finance its activity, such as some research activity or say some development of a particular molecule or something, or some new medicine, etc. The